All right, let's talk about a financial tool that is, for a lot of us, the single most important investment we'll ever make, even if we don't really know what it is. It's the Target Date Fund. And look, if you have a 401k, you've probably got one. But what is it actually doing with your money? Let's dive in and figure that out.
Saving for retirement these days can feel like you've been handed a puzzle with 1,000 pieces, no picture on the box, and everything's on the line. The rules have totally changed from our parents' generation, and for millions of people, it's just a lot of stress.
I mean, have you ever had this happen? You open up your new 401k plan, and bam, you're hit with this giant list of mutual funds with all these confusing names and ticker symbols. What are you supposed to pick? How much do you put where? If you've ever felt that, you are not alone. It's a classic case of choice overload, and it's a real problem that needed a smart solution. So, why does this puzzle even exist? Well, it's because there's been this massive shift in who's responsible for your retirement. Back in the day, many companies had pensions, what they called defined benefit plans. The company took on all the investment risk and just guaranteed you a check for life. Simple. But today, we live in the world of the 401k, a defined contribution plan. And the big, huge, critical difference is that all of that risk, it's been moved from the company straight onto your shoulders. So in response to this huge shift, the financial world had to engineer a solution, something that could take on that complexity for you, something that could basically put your retirement savings on autopilot. And that solution, as you've probably guessed, is the Target Date Fund. So what is it? Simply put, a target date fund is an all-in-one portfolio, kind of like a fund of funds that's professionally managed for you. All you have to do is pick the fund with the year that's closest to when you think you'll retire, like, say, 2055. And that's it. The fund literally handles all the rest. It is the ultimate set-it-and-forget-it investment. Okay, but how does it actually do that? How does it work? Well, the magic behind the curtain, the real secret sauce, is a concept called the glide path. This is what makes the whole thing run on autopilot. Think about it like this. Your career is a long flight, and retirement is the airport you're trying to land at. The glide path is like the plane's automated landing sequence. You don't want to come in for a landing at full speed, right? Of course not. The glide path makes sure you have a nice, smooth descent by gradually, automatically reducing your risk as you get closer to your destination. So here's what that landing sequence looks like. When you're young, let's say 25, your fund is going to be really aggressive, mostly stocks, aiming for maximum growth. You've got time, so you can take the risk. Then by the time you're mid-career, maybe 45, it automatically shifts to a more balanced mix of stocks and bonds. And then as you get right up to that retirement date at age 65, the fund gets very conservative. It shifts mostly into bonds to protect and preserve all that money you've worked so hard to save up. Now, this is where it gets a little more interesting. See, not all glide paths are built the same. They generally follow one of two big philosophies. Is the fund designed to get you to retirement, or is it designed to last through retirement? It's a subtle but really important difference. A TOE fund's main goal is to be as safe and stable as possible on the day you retire. It's all about protecting your nest egg at that single point in time. A through fund, on the other hand, operates on the idea that retirement isn't just one day. It's a journey that could last 30 years. So it keeps a little more in growth assets to make sure your money lasts. And this table really lays out the trade-off. Two funds are obsessed with what's called sequence of returns risk, which is just a fancy way of saying they want to protect you from the horrible luck of a market crash right when you need to start taking money out. Through funds are more worried about longevity and inflation risk, the danger that you'll live a long time and your money's buying power will just get eaten away over the decades. It's really a choice between short-term safety and long-term staying power. But honestly, beyond all the charts and graphs, maybe the most powerful thing a target date fund does is protect you from yourself. This is where finance crosses over into behavioral psychology, and it's fascinating. The legendary investor Benjamin Graham absolutely nailed it with this quote. So often, the biggest threat to our financial future isn't a market crash. It's our own emotional reactions to a market crash. And target date funds are specifically engineered to take those emotions out of the equation. So how does it do that? Well, take loss aversion. You know that sick feeling when the market drops and your gut screams sell everything? The TDFs automatic rebalancing does the exact opposite. It buys more when things are cheap, all without you having to lift a finger or fight your own panic. And that choice overload we talked about, the TDF solves it by making things one simple decision. It's a system designed to enforce good behavior, especially when we're tempted to do the wrong thing. Now, beyond behavior, there's another hidden enemy to your wealth where these funds can be a huge help: fees. It is so easy to gloss over a tiny percentage point, but look at this number. According to the US Department of Labor, a seemingly insignificant 1% difference in fees can vaporize over $250,000 from your nest egg over time. That's life-changing money. The fact that many TDFs are built to be incredibly low cost is a massive, often invisible benefit.
Okay, so TDFs are clearly an incredibly powerful tool, but they aren't perfect. They aren't a silver bullet. So let's take a quick look at some of the valid criticisms and see how the industry is trying to evolve. The number one critique is that it's a one-size-fits-all approach. A target date fund assumes everyone retiring in, say, 2055 is exactly the same. But it has no idea about your other investments, your spouse's 401k, your personal comfort with risk, or your specific tax situation. It's a fantastic default option, but it's like a suit off the rack. It fits most people pretty well, but it's not custom-tailored just for you. And that brings us to what might be the most exciting evolution in this space. To solve that need for a reliable, predictable income in retirement, the newest generation of target date funds are starting to build in features that can guarantee you a paycheck for life. Think about that. It's like embedding a personal, private pension right inside your 401k. It's trying to solve the very problem that started this whole thing.
Which leaves us with this one last really interesting question. We started this whole story because the old pension system went away and all the risk fell on us. And now, the single most popular investment designed to manage that risk is evolving to bring back the single greatest promise of a pension, a predictable income for as long as you live. Could the future of retirement look a lot like the past, just in a totally new package? It's a fascinating idea, and we'll just have to wait and see.